We still have commodities leading the way in the number one position. It's actually flat since the last podcast. It's funny, it did rally up and then kind of came right back down to this 313 tally point position it's at. Cash is in the number two position. It gained 9 points and it's at 193. So it is firming up in that number two position. So one being commodities, two being cash. Domestic equities in the third position lost 21 points since the last podcast. It's sitting at 170 right now. So it continues to deteriorate in that third position, while international equities lost 18 and it's at 158 in the fourth position now. So it's deteriorating as well, but a little slower, but still deteriorating significantly. Fixed income is in the fifth position. It gained 16 points. It's at 152. So potentially we could see, if these trends continue, fixed income take over in that fourth position and see international equities drop to the fifth position potentially. And then in last is currencies. It gained 12 points and it's at 105 tally points. So a lot of change. I mean, the movement that occurred is really what we've been consistently seeing, which is really domestic and international moving downwards. Cash obviously had that big jump upwards in the last month that we saw to vault it into that two position. But fixed income and currencies as well have been, for the most part, gaining as well. So it's been pretty consistent.
So that's interesting, Chris, and just the thought process here. Commodities being number one, and that can go on for a period of time. But if commodities are number one for a long time, commodities are an input cost to business and to consumers. So that's not a positive long term. Short run, of course, any investor can make money on different commodities. But so while commodities are in the number one position, we're in a kind of in a weaker phase. Cash is up there. It looks like fixed income and currencies are close to overtaking U.S. stocks and international. They're within striking distance. Like 1 week's change could change all that. And then we're in full-on bear market mode. Usually the bear market mode is commodities, fixed income, cash, and currencies in the top 3 and 4 positions.
Yep. Yeah. I mean, I think that would be a good description, kind of what we're seeing here. I mean, I think we could easily see fixed income this week, depending on how the markets act, and then currencies could easily follow in a week or two with where they're at now. So, but yeah, the trend there would definitely be more of a bear market.
Yeah. So we're not quite in full-blown bear market yet. We're in a bear market, but about half the bear markets that go north of 20% down end right around here, and half go much lower, 40 to 50%. In 2008, went down 58%. The 1970s was the worst bear market in recorded history. That went down 70+% from the high, even worse than the depression market in the 1930s. So we'll see how it all shakes out. Well, thanks, Chris, for the update. We had a big week last week, a big up week, 5-6% in all the indexes, which was a bounce off the bottom, which closed the previous Friday before that at recent lows. But then it rallied on very light volume, and it rallied all the things that weren't working in the collapse started working again on light volume. So that's kind of a feeling that it's a reaction and kind of a pop, but not a real serious rally. But then later in the week, it looked like a little bit more buying. It looked a little bit more serious than earlier in the week, but still not enough to say, hey, this is really a bottom, right?
Yeah. I mean, I think that one thing to consider, I mean, it was obviously a big week up, 5-6%. But there's a kind of an anecdote in the markets that, the strongest up weeks usually happen in bear markets when the markets go down. So that wouldn't be necessarily uncommon for, a downward market. You do see pops, people get exhausted of selling. But, I think with what we see, like you said, Brian, the light volume kind of increasing towards the end. And then to kind of start this week, we've seen a little bit more of downward movement a little bit. I think that, I don't know if we've necessarily hit the bottom yet. We haven't seen that yet, I should say.
Yeah, look, and I'll talk a little bit further about that in a second. But, when I'm trying to remember back to the bull market history, how often have we seen a 5 or 6% up move in the market in a bull market? Not very often. if I can remember any.
No. I mean, it's very rare. I mean, 5 or 6% moves are rare in and of themselves. I mean, those weeks, and we've had a couple in May. We had a couple, or at least one in May. So in the last 2 months, we've seen at least a couple 5 or 6% up weeks, which is pretty crazy.
So we're in a bear market and everybody's a little shell shocked, right? Because their portfolio's down. So we have a big 5 or 6% up move. And everybody's like, yeah, okay, that's kind of normal. Well, it isn't kind of normal. I mean, at all. We don't get those kind of moves in bull markets. So we have a big up move price wise. And everybody's like, okay, all right, fine. But they don't see it as unusual. It's quite unusual and only happens in bear markets. But then if it doesn't really confirm with more strong volume, going through naturally, this Monday, the market was fading a little bit. Then today we had a big up move on the open. This is Tuesday the 28th. But now it's down as the market is reacting to some other numbers too that came through, consumer sentiment numbers, right, Chris?
Yep. Yeah, some weakening numbers there. The market's kind of rolling over a little bit on some of the economic numbers.